Hello guys, I'm just going to, as usual, check if things are fine. That you can see me, hear me, whether audio and video or both are fine. And once you get a sign off on that, we'll jump in and start discussing this. And so do comment and say whether the audio is fine, whether the video is fine, whether it's visible clearly, whether the screen is clear, all the rest of it. I'm going to share my screen, read an article, and then discuss that. And so I'm going to discuss about an interesting article on the press by this magazine called The Ken, which is an interesting magazine. They take a bunch of industry sectors and they write on business. So they're a business magazine. The couple of things I like about them is that they outline a story. So they're more palatable. They don't get caught in. They outline the story before they go into the details. So it's a very good magazine for people who are just starting off and getting curious about business to start reading into, start digging into. I remember when I was in college, when I was doing my MBA, I hadn't thought about any business of any form for forever. And then it was richly recommended that we read pink papers and get to know about the industry and business. And I knew jack about it. And every time I would look at a pink paper, I would just get intimidated by the language. And so they talk about monetary easing, fiscal deficit. They'll talk about industry structures and profitability shrinking and squeezing out the private sector and all kinds of terms in economics and finance, and all of which used to intimidate me. So I would just stay away from it. I did that for a long time, and I really never took to reading and understanding business news. I later realized that a bunch of these, the press is too jargon filled. So you have to learn the jargon. And I worked in the financial sector. I don't know if you guys know this. I worked in the financial sector for many years, for about 6 years. And I was in charge. I was a research publisher. I was an equity research publisher. So it was my job to write reams of reports asking people to buy the stock and sell that stock and modify their portfolios and all that kind of stuff. So speaking that language became the norm. So I had to talk shrinking of operating margin and expansion of cash pile and EPS accretive and higher multiple and lower time to change, best time to change portfolio and all kinds of stuff. And so that's when I learned the jargon. But I realized that the jargon is an intimidating part of understanding this press. And so we're going to do a bunch of interesting articles on themes where we look to demystify, or at least give you guys a toolkit to understand this press. And I know a lot of you are interested in business. You're very very curious, and you're all into to read and understand this. So I'm going to try to see if we can demystify that a little bit. That's the idea behind this session. Right? Now, what is do all MBA graduates understand all of this? I can tell you that they don't. And I graduated in my graduation pool, but if you take 80% of them and gave this article, they would read the story and not really understand any of the finances. And so the financial part is not something that everybody winds their head around comfortably. It's not something that's that crucial. It's not something that MBAs understand very naturally. And quite often we get even the guys who are publishing this stuff get caught up in the numbers and make mistakes and not give striking clarity as easily for us to wind our head around. And so I'm going to start off by saying let's read this article. It's an interesting article. The magazine's name is The Ken. The one good thing they do is they write stories background before going into detailed data. So it gives you a flavor for what this is about. So it's good for any beginner wanting to know about business. Two, they're a paid subscription, but they give one free article, give or take, every week. So if you're on the website, it's registered and you don't want to pay big, it's not very expensive. You can buy it also if you're very keen on business. But even if you're not and you just want to know about this, then be part of their mailing list, read that one free article every week. You'll get exposure to a variety of sectors and you can start speaking that language. It helps in both senses. Right? Lovely. I'm just going to dive in, share my screen, read that article and take you through that article. This is about OYO. I want to pick an article in a company that all of us have heard about. So I'm going to give you bit by bit through that the background of this and what the industry is and what the language is, what the terms are, so that you can wrap your head around the next 2-3 articles you read on OYO or something on SoftBank or venture capitalist or funding or whatever that is. Fine. So at least when we were graduating, funding was never a theme. Many new companies got funded and all that, but the whole venture capitalist industry in India kind of took off in the last decade and a half, and everybody or the other is talking about funding and talking about this Series A and Series B and angel funding and support funding and reinforced funding and all kinds of stuff. And so I find that sometimes discomforting to talk about that, because I don't know why we're all interested in knowing how a company's initial phase is being funded. Is the company profitable? Is the company sustainable? Do they fill a crucial gap in the market, or do they fit a social purpose? Do they treat their stakeholders fairly? Are they meaningfully generating value? Those are the questions that are important. But these days, all of that gets hidden, all of that gets pushed away, and then says, "Oh, they've got funded, they must be great." Are they getting funding? Who's funding them? That's the guy who will fund them. Does he have a brand? Is it really cool? Can I talk? Now that they've got funded, that means that they are brilliant. Sometimes the funding is looked at as a be all and end all. Fine. So we're going to discuss that also on OYO. Fine. Lovely. So I'm going to jump in and read this. Read that article. Let me see if I can do a display capture. Stick myself in the corner. Do this. Let me just check this, remove this. Yeah, the display capture works. So I'm going to go to the article, read that, and then take you through this part. And so OYO's Battle of the Bulge. OYO is currently the most important startup in India, if not the world. Hyperbole? Maybe not. For one thing, the budget hospitality startup is currently the great white hope for SoftBank and its $100 billion vision fund. And SoftBank is run by a Japanese gentleman and they have a lot of money. They have a lot of money. They've raised a series of giant chunks of money. They're backed partly by the Saudi capital. And Saudis have a lot of money, a ton of money. To just give you a sense of how much the Saudi are worth, how much money they have. They were planning to list the flagship oil company that Saudis have, and that could have a market cap of $1 trillion if some of the more optimistic numbers are thought. That's one company. And so Saudis have a ton of money, hard cash, and they have put a lot of money into SoftBank. So this is a fund that has tons of money. Bottomless was the description frequently used to describe any company funded by SoftBank. So they would go on, their idea is to look, I want to find transformative businesses that can be a brand for the next 25 years, driven by technology, focused on a global footprint, something that can change the game. And so game changer, massive footprint, those are all words that you'll find bandied about a lot in any SoftBank invested company. If SoftBank's crown jewel turns out to be a lump of coal, the fund can all but kiss its chance of raising the second vision fund, which is already struggling. Goodbye. If they're trying to raise a second vision fund, it should be at least as large or bigger than the previous one. And SoftBank was considered a big brand to get a backing from, but SoftBank got beaten up a little while ago by this company called VARC. And so SoftBank supposedly banks big technology companies, technology that can transform the world. But it looks like some of the companies that they have backed are kind of real economy companies, where the front end is technology, and therefore they're probably not worthy of a technology valuation, but a broader economy valuation. That's been a problem for SoftBank, especially with VARC. So do read up on VARC. It's amazing fun about how crazy lunatic some of these investors have been. How some of the guys who ran the company have been, how people get caught up in an idea and don't really do the numbers and do some checking out of basic facts. So don't just because any company is backed by a big funder and is funded and raised capital and is visionary, you don't get taken in by that. Read what they are about and see if it makes sense to you. Right? So back to OYO. OYO, all of you must have heard of OYO. OYO is a company that has a lot of rooms booked in India, and that they own a bunch of these rooms, or they own the rooms in these hotels, and then they rent them out. They bring these companies up to one standard OYO level. So OYO offers a guarantee in terms of hygiene and presence, and you take an OYO room anywhere, there's a brand backing. So OYO's promise to customers is, hey, you might Google and find out a bunch of rooms. You can go to TripAdvisor or Make My Trip and you'll find a room. And then they're basically hosting these rooms, which somebody else has done. Whereas with OYO, you get a guarantee. We work with the guys. So we bring people on board to OYO, they give you a certain comfort and an assurance of what to expect. And that's a proposition that OYO has. Right? So let's get back to this. So they're very different from Make My Trip, TripAdvisor, all of them. Make My Trip, TripAdvisor are purely intermediaries. You host there, they take a cut, you get the room, they do the advertising, you get your revenue, you're good. When the reviews drive it, they're allegedly neutral. Whereas OYO has a kind of foot in both camps. You can book through OYO, you can book on TripAdvisor to an OYO room. OYO owns properties and OYO leases rooms of properties. Any OYO room maintains a certain standard. So you can be an OYO hotel. That means you're running it, but you're basically agreeing to comply with a set of norms that OYO has set out for you to be part of the OYO brand, for which you give them a cut as well. So it's not TripAdvisor, but a little more involvement. OYO is more involved. OYO owns rooms. OYO leases out giant numbers of these rooms. They basically are in charge of the inventory. That's a very important distinction between what OYO does and what TripAdvisor does. Right? For another, OYO I'm going to come back to the passage. OYO is the second largest startup in terms of valuation. If OYO flames out, the seismic repercussions on startup funding will reverberate for years. And so I'm not a big fan of adjective-laden financial press, but sometimes we like to read, and especially when you're starting out, it seems to make an impact. He's talking about something very important. Seismic repercussions reverberate for years when OYO flames out. And so it's flowery prose. So let's gloss over that. So why are we discussing this now? Because OYO is currently facing the unenviable position of having to fight the Battle of the Bulge. History aficionados will recognize the Battle of the Bulge as an iconic last stand battle during World War II, one last desperate offensive campaign that Germany launched to avert what seemed like inevitable defeat. OYO's current predicament is something similar. The last year has been annus horribilis for OYO. It saw widely publicized problems around dissatisfied hotel partners and disgruntled customers, culminating in a purge where nearly 20% of the company's 12,000 strong workforce in India was laid off. There were similar layoffs across its other group entities around the world. OYO now needs the last-ditch battle to prevent these eddies from cascading into a deluge that takes the company under. They've had a bad year. When they had a bad year pre-COVID, they had an issue with the terms the hotels were given. They had issues with booking. They had issues with how the hotels were not compliant with OYO standards, how the hotels were fighting back on some hidden charges. They had a series of customer issues and service provider issues. Right? This is pre-COVID. All this happened, kind of started happening before COVID. They've always had a profitability issue. And a lot of these startups have a profitability issue. It is unfashionable to have a startup which makes profits. Right? So they've always had a profitability issue. But OYO has another bulge problem. Back to the passage, the bulge of the wallet kind. A large part of OYO's mercurial growth can be attributed to the enormous sums of money raised from its financial bankers, most notably SoftBank, which owns nearly 50% of the company. Post the chastening that SoftBank received under the WeWork IPO imbroglio. Read about that. At its peak, WeWork was valued at $47 billion. Right, so this happened. They wanted to do an IPO. The IPO didn't take off. They downgraded it and said, look, it's not 47 perhaps. I think 46 or 47. Said, maybe this is not the number. We'll do it at 20 billion. It's not like bartering from a vegetable seller. And from 46, it crashed to 20 in weeks. And it didn't take off at 20. It was further downgraded. And then it never took off at all. And SoftBank had to lend them something like 7-8 billion in order to tide them over to fight the next battle. So it was a complete disaster. So that was a time when it started looking like, okay, SoftBank has put money in it. What used to be a scenario where SoftBank has put money, this must be a great company, suddenly became SoftBank has put money in it. God knows what's sitting inside. Maybe they'll bleed like VARC. Like others, back to the passage, like other SoftBank portfolio firms throughout the world, OYO has discovered that even a seemingly infinite 100 billion fund has limits. It has been forced to abandon its grow at all cost mantra to a sustainable path towards profitability. And this is very crucial. This is something that is going to happen, or is happening, or has happened to practically all startups in India. And so you name it, they have had a mantra of saying, look, let's grow berserk. Let's fund this side and subsidize that side. So there have been intermediaries. Tech being an intermediary has been a theme. There's been a theme with OYO. That's been a theme with Uber, Ola, Swiggy, Zomato. So they all occupy a space in the middle. And so there's a restaurant, there's a consumer, there's Swiggy in the middle. There's a taxi driver, there's a customer, there's Ola in the middle. And so what they do is they want to become the inevitable disintermediary. Anyone who wants a taxi has to look at Uber or Ola. They want to become that. And they want to do that today, really quickly. So what do? They throw money at the problem both ways. They offer big discounts this side, fantastic terms that side. Everybody comes on board. And that mantra, I want everybody to come on board. I want a giant market share. I want to kill the fast track. I want to kill home delivery from restaurants. That is a starting point. So now at a point of time where they've got some kind of share, they want to recognize, they want to say, okay, the mantra now is shifted to, okay, is there sustainability in this model? And can I make money after removing off the big incentives I pay to both sides? If I remove the big incentives, after removing them, will my market share still be there? Will the unit economics start working? And so we have been talking about one kind of uni, which is unicorn. I think soon we'll talk about other kind of uni, which is unit economics. It's very crucial for some of these businesses. Do you make money on each transaction? If you don't, then everything else is a moot point, right? The companies that did not cross over, there was a messenger called Hike that started struggling. Apparently, even Ola and Uber are not yet towards profitability. Swiggy and Zomato are not yet. Zomato went towards profitability and then has climbed back. Urban Ladder, Pepperfry have struggled. So quite a few companies have not gone towards profitability as they thought they would, even after they hit some size thresholds. Right? That's a crucial point. You get share and then you start becoming profitable. If you don't become profitable, you're in trouble. Right? OYO's recently released audited financials for the year is a good starting point to help answer this question. The sum of its part, the headline numbers make for dire reading. According to OYO's latest results, the consolidated revenue stood at 951 million compared to 211 million in the previous year. This is massive growth. 4x, 5x in a year is fantastic. Right? This is impressive. This is 7x increase in losses. They made this much revenue. They've had a loss of 335 million in the same period compared to $44 million in the prior year. So you can argue that revenues have come at the cost of the numbers becoming worse. Right? These numbers tell us that not only are the losses growing much faster than revenue, the net loss as a percentage of revenue is also widening. The growth in loss is bigger than growth in revenue. In an accompanying annual report card, the company further stated the total gross margin fell from 10.7 to 7.1% this time. Hardly signs of a company on its way to profitability. The gross margin is a very interesting number, and so you guys should know this. If you take revenue and then you subtract whatever costs go away in delivering exactly that product, what you have is gross margin, gross profit at the end of it. What do I mean by that? Take a simple example. Suppose you run a restaurant and you price a dosa at 50 rupees. Right? So whatever goes into the cost of just making that dosa, that rice, that batter, that oil, the cost of that guy making it, rolling it, putting it together, giving it to the customer, that cost alone you subtract, you'll get gross profit. The restaurant business will have a gross margin of 85%, 90%. Dosa costs 40 rupees, you think that is not that expensive. Making it, the ingredients that go in, just that will be $6, $5 tops. right? Not more than that. What are the other costs? This is, look, I need to have a restaurant. I need to have maintain the ambience. I need to have a certain decor. I need to advertise. I need to have the lighting done well. I need to have good service providers. Somebody who says hi, hello, please come in, etc., etc., etc. Those all add up. These are all operating cost, and after that comes operating margin. Right? So gross margin is for every 100 rupees I get in, what is the cost of delivering? So if you run a high-end service business, then your gross margins are very high. But if you are a reseller, a distribution company, then at the gross margin level, you get chopped off. There's a big chunk at the gross margin. Your gross margin itself is very low. Right? So here for them, gross margin fell from 10.7 to 7.1. So the gross margins are falling. If your gross margin negative, that means for every rupee you make, you're losing buck in the cost of just providing that service. Forget about your advertising and one-off spending and big boost and all that. All that is irrelevant. But just on delivering, for each room you make loss. Right? The company's management though sees it differently. Of course they do. All company management see bad stories differently. OYOs executives led by CEO and founder Ritesh Agarwal see the company's business as one that can be broken up into markets in 3 different phases. The top of the pile is India, which is both OYO's largest as well as the most mature market. Mature market is a market where you've been present for a long time, where you should be making money. In India, the company claims it is driving the best cost margins and chasing a path to profitability. Then there are markets like China and Southeast Asia, where the company has already established operations and made substantial investments. These investments have dragged the bottom line down for the year ended March 2019, but are now primed to deliver returns, both in terms of revenue as well as gross margins. Finally, there's the rest of the world, markets such as the US and Latin America. OYO has been present in the market for less than a year and is still in the process of setting up operations. So clear, so very mature market, intermediary, and really new. If you're making profits really well in your very mature market and you're losing money because you're entering into lots of new spaces, that's all right. And so this table provides a summary of the company's numbers for year ended March 2019. So India is 604 million, China is 307, rest of the world is 41. Operating expense is higher in India, 676, loss of 95 million, loss of 200 million, loss of 55 million, even on a revenue base of 41, leading to an overall loss of 335 million. Whatever it was. So still loss making. Key point to note, it is loss making even in India. Fine, so that's interesting. What is EBITDA? Interesting term, earnings before interest, taxes, depreciation and amortization. Fine. It's earnings before interest and taxes. Obviously, you'll do all your profit, then pay your interest, then pay your taxes. That comes later on. Only if you make profit, you'll have to worry about taxes. What is depreciation? Suppose you buy a bunch of computers, and a computer can last for 3 years at least. That's an assumption you make. Suppose you spend 10 lakhs buying computers. You should not be putting all 10 lakhs as cost for this year. Ideally, you should be saying, okay, this will last 3 years. So I'll break this 10 lakh into 3 components. I'll put 1/3 of that, 1/3 of that, 1/3 of that in 3 years. So that my accounting is reasonable because I've got 10 lakhs, spent 10 lakh, but I'm going to get value for the 10 lakhs over 3 years. That means this 10 lakh asset is being depreciated over a period of 3 years. And so for tangible, visible assets, the DK is called depreciation. For intangible assets, you buy a brand, it's called amortization. And so this is before those costs. That's what you make EBITDA. That has been negative. Fine. Let's put these numbers to the test, starting with India. Fine. So you made revenues of $604 million. This is up from 211 million the previous year. The revenue grew almost 3x. The losses went up not that much. And as a percentage of revenue, losses in India were improving, still loss making, mind you, but not bleeding as much as before. So their claims of operational improvements might be true. So the Aditya Ghosh, previously the CEO of OYO India and currently a board member, echoed this claim in a press interview. He stated that gross margins increased from 10.6 to 14.7. So the gross margin positive and increasing gross margin in your most mature market. And indicating the strength of our business model. When all kosher, when all good, not quite. There's an issue of expense allocation across segments and markets, burnishing the economics of one segment by shoveling expenses into other segments. So this, the author is just saying, okay, and whenever there's a consolidated entity broken into three parts, you cannot really be sure of just breaking it into three parts the way they mean it. Suppose they had they pay big salaries for the CEOs and the top management. They could have put all of that as business growth cost and stuck it into rest of the world and China, except maybe the CEO and CFO, taken a bunch of big cost and stuck it under other categories. The rent of their office could be for business, could be attributed to the China business. But they do run a China business from their main office. Right? So companies have the freedom to shift one thing or the other. And the author is saying, so you can, by shoveling expenses into other segments, is almost trivial from an accounting perspective. That means it is possible. Several large companies do this routinely to build a narrative that is palatable to their shareholders and the public at large. Right? So OYO has a mind-boggling array of no less than 40 subsidiaries across India and the world. They've acquired a lot of these companies. So it is simple to take $10 million from the marketing section and similar spends from other departments and move it from main Indian entity to another subsidiary. So it's possible. So we'll have to be careful about that. But let's give OYO the benefit of doubt for now. Let's assume that we can take these segment-wise numbers at face value. And the top line operating revenue number of 581 million seems mighty impressive. The gross margin translating to 88 million is equally so. Both these numbers are misleading. And why so? Effective 1, OYO changed its accounting method to recognize what was known as net realized revenues as revenue. In its filing, the company says that revenue from sale of accommodation services is recognized on gross basis as we gain control on stay services before providing it to the customer. We consider ourselves as a principal in arrangement as we assume obligation towards performance of stay services to end customers. A lot of people do this, and they're always the issue of gross revenues and net revenues. And so I'll give you a simple example. Suppose you run a YouTube channel. You get money from YouTube because you have a large channel and you get advertising. And so you can say your channel is generating revenues of 10 lakhs a month. That's a lot of money. Right? Google takes away 30% of this plus. So they charge their taxes, which you can then later offset and all that. More than 30%, depending on what size you are. So you will get 7 lakhs. I'm just doing an example of numbers, which is a significant amount. But the gross revenue is 10 lakhs. Your take is 7 lakhs. It's a big difference. And so you can claim that my channel generates 10 lakhs of ad revenue. It does. But when you claim that, the guy receiving it thinks you are making 10 lakhs. You get only 7 lakhs. What OYO has done is change from one norm to another. So they're losing a cut of their revenues somewhere along the way. But they're saying, look, we have control over the proceedings. So the original 10 lakhs is what we'll count as revenue. The shifting of goalposts means what was earlier considered revenue is now considered as gross margin. So they started whatever they got as revenue. Now they're saying the original part is revenue. This new thing is after I make 10 lakhs, of which I give 3 lakhs to YouTube. Instead of saying I'm getting only 7 lakhs. You can account either way. But if you're saying my revenue is 7 lakhs, or you could say my revenue is 10 lakhs, of which I give 3 lakhs to YouTube. Okay, the difference, the way they're stating it, that is important. If you strip away this cosmetic change, the numbers are underwhelming. Even this $88 million figure is inflated. It doesn't provision for commissions paid to selling agents such as online agent Make My Trip, which amounts to $26 million and needs to be netted out to get an accurate picture of the company's true top line. What I mean by that, the 580 million they make through the rooms, the room operators get 85% of that. These guys get 88 million OYO. They don't get all the 88 million because there's a further intermediary on top of them, which is Make My Trip. So I go to Make My Trip, book a room, book an OYO room, which I then go and live in, provided by Alpha Hotels in Mysore. I pay 10,000 bucks for the room, of which Make My Trip will take 1,000. 9,000 goes to the hotel guy, who then gives 1,500 to OYO. Right? What OYO is saying, I'm going to call not the 1,500 as my revenue, but 2,500 as my revenue, of which I'm giving 1,000 to make my trip. Doesn't matter. But for every 10,000 that's generated, they get only 1,500. Finally, the room hotel guy gets one big chunk. Make my trip take something off the top, and then the remaining is what OYO gets. As long as you're consistent, this doesn't matter. But you change from one thing to the other, then you might look like you're growing, whereas you're just changing the accounting standard. But optics aside, is that just a matter of semantics? After all, you can call it net operating revenue or gross margin or even take rate. Take rate is very interesting. For every room, what do I get? What do I take? What's my take rate? But the fact is that this number has gone up from 10% of GMV to nearly 15%. This is interesting. GMV is the net amount I pay. So out of 10,000, if the room costs 10,000 bucks for the customer, what does OYO finally get? Instead of getting 10%, it's now getting 15%. What goes to make my trip on TripAdvisor and what goes to the hotel, forget about it. Finally, instead of 10% of what the customer is paying, they're getting 15%, which is good. For a company like OYO that has historically had even negative take rates. A lot of these companies have negative take rates when they start off because they have to get the hotel on board. Otherwise, the hotel guy won't come on board. He'll say, look, I'm getting 3,000. I'll sell through OYO and then you'll give me 2,700. I'll anyway fill my room, Bob. Why should I give you money? So these guys incentivize him and say, look, you will get 3,000. For every 3,000 you make, I'll give you 3,200 if it comes through me. The idea is once he's on to OYO, then a year later I can bring it back to 2,700. He won't mind because I'm giving him so many rooms. After that, he can't go out because without me, he is in trouble. That's the transition OYO wants to put in. And like how Uber did, like how Ola did. So 15% looks fantastic. And there are still questions to be asked. So I like the way that Ken does it. They break the numbers down, and then for every idea, they have asked you more questions. As of March 2019, OYO had approximately 180,000 rooms in India, adding 10,000 rooms a month. It's a frenetic rate. Over the course of that year, OYO's employee base from 2,000 to more than 8,000. The scale of staff growth was required to onboard new hotels and manage operations at this scale. It is not a coincidence that 4x growth in staffing mirrors 4x growth in revenue. This is important. And the delight of running an online company, of a tech company, is what is called a scalability. There's a non-linearity in there. And I'm claiming to be in a non-linear business. So I'll speak this language if I ever go out and ask somebody to invest in my company. What will I say? I'll say, look, I put tons of content online. I take classes. I'm good at teaching. And I know that I have so many students at my customer base. And I can tell you, in 3 years, we'll double. The beauty in this, in 3 years, we'll double. But I run a product, and therefore my cost won't double. And 3 years later, we'll double again. Again, my cost won't double. So once I set it up, my path to profitability is the revenues keep going up without the base not increasing. All good, except it doesn't happen that way. Revenues, the biggest cost driving revenue ends up being a sales force. And that is non-scalable. So for them, it's staff growth. And that seems to be non-scalable. And so OYO is closer to a traditional hospitality company where there is a linear dependency on staff and infrastructure. I double staff, I double infrastructure, my revenue doubles. So where is the scalability in the model? Why will you become profitable just because revenues double? That's a question. To combat the natural limits of a hospitality business, by its own admission, OYO cut corners galore. And salespeople oversold OYO to hotel partners, and once the hotels were onboarded, hidden charges and opaque fees became commonplace. This has been a common path. And so in many ways, Uber set this in motion. And before Uber, it was YouTube. And the mothership here was YouTube. What YouTube did originally, they invested, they put incentives, get a lot of people to come on. They made the YouTuber as a glamorous, fantastic way to generate money once you had content. Then Google took cuts. Google was very light originally on copyright violation. There's a big issue. For the first 10 years of their business, they were flooded with copyright complaints. So they would just let anybody willy-nilly upload content. So the entire music albums would find place on YouTube. They were filled with lawsuits. Right? Slowly, ever so slowly, they kept changing the terms for YouTubers in their relationship with YouTube. And so YouTube content shot up like nobody's business. YouTube ad revenue shot up fantastically. YouTubers saw less and less of that money. But by that time it happened, YouTube became inevitable. All of us just go to YouTube. So the content development guys cannot afford to be not on YouTube. And so they became the incumbent provider. So they're fine. Likewise, Uber and Ola. They give delicious terms to get drivers on board and then put the squeeze on 2 years, 3 years down the line. The more of a market share they have, more of the inevitable provider they become, the more they can squeeze both sides. The idea is that's what these businesses call by the moat. The moat is in traditional times, you have a fort, you build a moat around you, put a packet of water and put alligators and all kinds of stuff thrown in. That's your defense. Nobody else can come and take that business. So if Uber is dominant in a city, it's nearly impossible for somebody to come in there and take away that position because the drivers are in standard relationships. Customers all have Uber installed. It's incredibly tough to get to a critical size to make money. You have to be ready and willing to bleed money for 3 years. It might not be worth it. So you own a city. And so the idea is very similar. You think about Uber, Ola, Swiggy, Zomato, OYO. Years ago, YouTube, some education companies whose names I'm not sure I can state right now. All intermediaries. So they get providers on one side, customers on another side, take a cut, provide very juicy terms to both, and then start squeezing both, particularly the providers. Providers are going to get butchered over time. Right? And OYO started doing it. We've heard stories of this. The monthly fees guaranteed to hotels were not paid in time or at all in many cases. The plethora of complaints from disgruntled hotel partners, press, as well as courts of law. Some of these guys have blatantly unfair terms written in terms and conditions. They say the terms and conditions can be changed by either party. You don't own the rights of what you're creating. All that is get written. And these people, when they're getting in, they get very juicy terms. They don't read the terms and conditions. They get on board. And then suppose you're running a hotel in a small town in Kerala. And then OYO starts filling 40% of your rooms. You become OYO certified. People come because it's OYO plays a brand role. Then you might fight with him. You can complain with him. But you're not going to pull the plug on OYO because you're worried. Suppose out of the 40%, I fill 10%. But if the remaining 30% don't come, then I'm becoming unprofitable. So you hang on with them. And that's their thing. They can push people once they become the inevitable provider, which is why if you ever run a business and you're having any of these distant intermediaries, build your brand. People should come to your business because of your brand, not because you're present on a platform. The moment the platform becomes all powerful, you're dead. All the platform guys are fierce capitalists. They're going to squeeze you. They'll never get any one guy get too big. Otherwise, it's like the tail wagging the dog. So YouTube has brilliant algorithms. We have a channel on YouTube which provides fantastic content. But YouTube algorithm, if you notice, it will not necessarily keep giving content from the same channel. The autoplay is designed to give primacy to keywords and not to channel. So you're hitting a couple of videos from 2 a.m. Automatically some other video will come in. Why? Because the YouTube doesn't want you to get conditioned to 2 a.m. content. So the default has to be a mixture. Because otherwise 2 a.m. becomes the brand that is pushing the theme and not YouTube. Now YouTube wants to have the handle on who's consuming what. So the moment the intermediary becomes bigger, the providers become smaller. You don't have room to do lots of things. So if you ever run a business where intermediaries are there, maintain 2 arm distance. Don't become reliant on the intermediary. You would have recently heard how BuzzFeed got butchered when Google changed algorithm or Facebook changes algorithm. You can't be reliant on one intermediary at any cost. This vicious cycle breaks OYO's fundamental brand promise of predictable and standardized budget hotel rooms. Because you see, these are hotel rooms, these are experiences, these are less reliable than YouTube. I have gone to rooms which are OYO rooms, and the guy sitting there is whining non-stop about OYO. Non-stop. I tell him, boss, I have 2 people coming in. I have another person who will come and visit me. He says, somebody comes to visit, you have to pay me $300. Look, we'll meet in the lobby. If you're sitting in the lobby, you have to give me $100. He's squeezing because OYO is squeezing him. He knows that we are OYO customers and we'll go and write OYO reviews. And he knows that he has a loyal clientele. So you become a second class clientele at a hotel just because you have come through OYO. So the customer, next, I have decided I'll not go to OYO. These guys don't have a handle on their provision. So they're going to screw you around. So these are the pushbacks that can come. Right? The recent round of mass layoffs has led to further uncertainty among both hotel partners and potential customers. Finally, is this number enough? Despite progressing from 10% to 15%, OYO's bottom line was negative. Remember, 15% is a large number. If I'm running a hotel business and I know that I'm getting $10,000, and if I'm giving 1,500 of that to OYO, that's a lot of money. And people are coming to me still because my brand is good. And I know OYO can squeeze me. I'll have a loyal clientele. I'll not give him all my rooms. And I'll make sure that I will not let it go beyond 1,500. I know that I can get screwed over by the intermediary. So I'll worry about that. But it won't go beyond 15%. The net loss bottom line of 84 million is almost as much as the actual top line. So even at this 15% take rate, they're losing as much money as their revenue. And the revenue is equal to their loss. So their operating expense is twice of revenue. Even at this rate, the company was losing $1 for every dollar it earned. You cannot improve it beyond 15%. Because if that happens, imagine what will I do. I'll run OYO. My rooms through OYO. I'll run rooms on my own. I'll price OYO at 10,000. I'll price my rooms privately at 8,500. I'll tell anybody you come here, I'll give you a discount. What remains for me is still 8,500. OYO takes 1,500 if he manages to sell at 10,000. The guys, more they know this, they'll check on OYO and then go back to checking on my website to see if there's a different price. OYO won't let them do this publicly. But if it's available on the side entrance, OYO's brand is killed. Because the OYO room you can get at OYO for a rate and directly at the hotel for a slightly lower rate. Once that jugaad comes in, his model is dead. This happens very frequently. Fine. So Apple takes 30%. Google takes 30%, anything on Play Store. So all of us, Swiggy, it happens in Swiggy. I don't know if you guys have noticed. Restaurants have a menu rate for Swiggy and a menu rate at the hotel, at the restaurant. They know Swiggy takes a cut. If he drives me business, I'll price it higher. Jo aa raha hai wo bonus hai. So that differential pricing, all these guys have accepted. So you mark it up for discount, mark it up for Swiggy, then run the game with Swiggy and run your restaurant business independently. But moment that comes in, the long-term sustainability of the disintermediary, that role becomes the guy who's disintermediating, the intermediary or the disintermediary, both mean the same. Actually, the intermediary, that word is better. That guy becomes redundant. That's very important. All of this means that contrary to companies' claims, OYO is still far from positive unit economics. And despite improved numbers, it is unlikely to progress closer to profitability from this point on. Then there is China. OYOs Financials show that China contributed nearly 70% of its losses. The company claims these losses were a result of entering a new market and involved front-loading of setup cost. Basically, they're saying a new market, so therefore we are making losses. But here's the catch. As of March 2019, OYO's presence in China was neither early nor front-loaded. The company entered China in November 2017 and has a base of 50,000 rooms in less than a year. In March 2019, Aditya Ghosh said, we actually treat both India and China as our two home markets. China actually exceeds India in the sheer number of rooms that it has today. This basically says they're conveniently calling it a home market and new market depending on where the numbers are going. In an interview in 2019, Agarwal claimed that OYO was already the number 2 hotel chain in Shenzhen, the fastest growing market in China. See, their model is premised on getting people on board to the OYO platform. You make it cross margin negative. It's very easy to sign up people. What do I mean by cross margin negative? I say, look, you are making 3,000 rupees. Come on, OYO. I'll take 5 photos, list you there, give you a watch for saying you are now a OYO customer. And I will list you at $3,000. Every booking you make through OYO, I'll give you 3,200. Why will a hotel not come on board? He'll come on board. At some point of time, OYO will call him up and say, look, I'm not giving you 3,200 anymore, only 2,800. And then they hope to retain him. Then they keep changing the terms. Right? So But now this game is no longer new. The guys know what this is. Right? Let's come back to this. Given the statement, they claim that losses in China were due to entering a new market that was in development and investment mode rings hollow. True. What is striking that the litany of adverse press reports emanating from China and other international markets, like Japan and the US, follow an eerily similar script to the complaints by hotel partners and customers in India. So there's a very fine art putting the squeeze on. It's a very fine art. You have to walk a line. Fine. So Uber does this fantastically. They give you discount, they give you coupons, they give you vouchers, they give you all kinds of things. Customers on here, they give this guy special incentives, additional incentives, extra weekly incentives, and all that get them on board. They kill the equivalent of a fast track and NTL and super track in the city. They compete with Ola, and one of them survives, or one of them becomes the leading provider wherever there are two of them, and then slowly they put the squeeze on. They will lose revenues, but the profitability will improve. What's a fine art? You piss off people, they'll say, screw you, I don't care what the terms are, I don't need this crap anymore. Fine, it still has to be meaningful, and you need to hang on to them and have that. And whenever they can lobby together and become a bigger group, if Uber drivers had a union, they would have killed many cities by now. Poor guys, they don't. Lure hotels promising minimum guarantees, renege on this commitments, provide a subpar experience for customers, a familiar playbook that has few positives. Factor in fears around how the coronavirus epidemic is likely to severely affect China's business. And it is all but guaranteed the company is destined to lose money heavily in that market for the immediate future. Right? So both Indian as well as international markets are far from profitability. Is OYO destined to lose the battle of the bulge? There is a silver lining. It comes from an unlikely source. We had previously reported OYO's recent 1.5 billion fund rise was led by SoftBank and Ritesh Agarwal himself. It's a very funny article. You should read this. Fine. So if we get time, at least go through that. Agarwal took a loan of $2 billion to finance this investment and provide a partial exit to investors like Sequoia and Lightspeed. These guys said, look, you guys are losing too much money. He said, okay, I'll buy you out, which is brilliant. Except Agarwal's $2 billion loan was personally guaranteed by Masayoshi Son, SoftBank's Mercurial founder. So OYOs is listed as valued at an enormous number, of which Ritesh Agarwal owns a large amount. Remember, this is stake, not money. And then he buys out a bunch of other players with money partly financed by the stock that he has as collateral, as a loan from SoftBank itself. So SoftBank lends the SoftBank CEO money to buy out the other players. So it's been weird transaction. So it could have been illegal in some places. Definitely, I don't understand that mechanism. In another world, this move by SoftBank's founder to issue a guarantee to a founder of a SoftBank-backed portfolio firm to invest into the same SoftBank-backed portfolio firm might have invited censure. It's creepy. It could have been perceived as unethical, if not outright illegal. But in our world, this is apparently business as usual. Given this personal guarantee, Masa has a vested interest to make sure that not only does OYO stay afloat, but that Agarwal repays the loan by selling the stake at some point within the next few years. So whether OYO is currently the most important startup in the world or not, it is certainly the most important startup for Masa. And in the final analysis, that is all it probably needs to win the battle. I would firmly disagree. I had a series of issues as a banker. I would never rate a company based on who was running it or which guy could come in. The model matters. I'm just checking to see if there's some feedback on the group and all that. Seems to be all right. If I've not got any adverse feedback, fine. So good article. Go through. Oops, I think I've gone to the wrong side. I'm going to move away from display capture. Go back to this. Remove this. Fine. So I'm going to remove this as well. Wonderful. Good article. I'll happily look at any questions you guys have. So this is a very interesting business, and it's a route many companies have taken. And so how that route works is going to be a crucial determiner for the success of our startup environment, not just in India, globally. A lot of the tech companies have marketed and pitched themselves as phenomenal game changers, starting from Uber but a bunch of them. If you look at India, Uber, Swiggy, Zomato, Ola, OYO, Urban Clap, a lot of them are basically saying that a bunch of providers, that a bunch of customers will provide that interface in between, will marry these two and take a cut. But in order to become the incumbent marketplace, they provide huge incentives this side, huge incentives that side. The idea here, for Amazon, if you're on Amazon, then you get listed and you have enormous reach. Amazon has become the number one place for people to buy anything from. And you don't have a normal path to discovery, whereas Amazon provides a beautiful path to discovery, and you have a good product. You have to be on Amazon, and it's inevitable after Amazon comes because the incumbent market. Right? But if I'm a painter and I'm in demand, and I get on an Urban Clap, and then somebody calls me over and I paint, and then the guy realizes that you are a good painter, he's going to call you over next time and not go through Urban Clap. If there's a demand supply mismatch and the intermediary is all powerful and the intermediary cannot be bypassed, then you have a winning game. If the intermediary can be bypassed, if a parallel offering can be given, if nobody is controlling the narrative, if the provider has freedom, so if the Ola guy is driving his cab, he can do his own rides also. Then Ola has no control over proceeding. At least Ola guys cannot do that because they're continuously tracked on GPS. But if I'm running a room, I run OYO here. I keep running my own set of rooms on the side. I collect cash. I cut off that 15% given to OYO. It's a very dicey game to play. But if OYO is not meaningful for me and him screwing me over doesn't really matter for me, I'm already on TripAdvisor and anyway, then I'll look to play that. The power OYO has is when OYO gets listed, they take a giant portion of the inventory. They don't let you list independently on TripAdvisor. But if they're all making this play, then the new hotels might become hesitant on coming onto the OYO platform. They'll say, look, I need to have my independent brand and presence anyway. I don't want to get consumed by that. And so very interesting. So a lot of them follow the same business model. Any business you run, be wary of somebody who says intermediaries, who's intermediating for you. If that guy becomes too big, he's going to squeeze you. Your game becomes, your brand matters. And if you're on Swiggy or Zomato, then the restaurant brand matters. There are some restaurants which people will buy from even without discounts at listed prices because they're good. Others need the Swiggy offer and Swiggy coupon and Swiggy token to survive. If you need Swiggy to survive, then Swiggy will squeeze you. If you're an independent brand and you're finding an alternate platform, you're good to go. So make sure that if you ever start a business, don't be at the mercy of an intermediary. They're fierce capitalists, so they will play this role. I'm going to look at questions. Governments have a tolerance level. Big tech is skating on wafer thin ice. People have forgotten what happened to Standard Oil. End game for big tech. Big tech issues is not customer profitability driven. By big tech, if you see Facebook, Google, YouTube, or Google and YouTube are now Alphabet. Facebook, Google, Amazon, the Microsoft, the biggies, they're profitable. They have a compelling proposition. Consumer market positions are dominant. The ad revenue business has ridiculously high gross margins. They have good operating margin. They'll survive. Their issue is with regulatory concern and privacy concerns. They are the inevitable places. We cannot now, as a people, imagine a world without Google, Gmail, YouTube, or Facebook, WhatsApp, Instagram, the two environments, or Microsoft on the cloud or on your operating system, or Amazon. And so then you might find the odd 3% of population who value their privacy above everything else and are not on any of these platforms. But most people interact with all of these platforms. So they are inevitable providers. Big tech's issue is not profitability. Big tech's issue is privacy and how much regulation can play a role and how much geopolitics can play a role. A tech company that's actually a real estate company backed by SoftBank. I wonder where we have seen that before. You guys should definitely read up on VARC. It has a lot of funny stuff. do one on the 2008 recession as well. 2008 recession did one on me. Fine, I quit my job after the 2008 recession, but I hated my job. So this was my day job. Look at company numbers, and so I had to write research reports on every set of financials I did. I did 1 or 2 IPOs, but mostly listed stocks. So I would look at their balance sheet, cash flow, profit and loss, business, make a forecast, value the asset, and speak to investors. That was my day job. I was not involved in startup funding, but more mature market stocks. That's a slightly different game, but it's all the same. You look at a bunch of financial statements, look at company industry, speak to CEOs, CFOs, speak to investors, and say how much an asset is valuable. And so that was my day job. And oh my God, I simply didn't like it. And so that jargon, the unending passion to sound smart, some aspect of it is to create a good story that will stick, and I resented that. So a bunch of these guys, Hike was there. Hike was $1 billion company. I don't know how many of you have even heard of Hike. It was a messenger service built for India, where with low speed internet you could still survive. Hike doesn't exist today. It was at one point of time valued at $1 billion. Urban Ladder is a wonderful company. I really liked them. I wanted them to do well because I liked what they were offering. I heard that they're not all wonderful for them. So quite a few of these assets. Sometimes the story goes way ahead of the numbers. You want the CEO to do well, the funding they've got, there's a glamour value to it, there's a social angle to it, there is an impact angle to it, there is you're listed at $5 billion, you're valued at $5 billion, the next round of funding values you at $8 billion, and then you go look at larger and larger numbers. There's a certain momentum. All of us feel some kind of it's a dream, it's an aspiration, but sometimes all of these are very notional. Some of the heavily valued assets come crashing. The public sector markets are more robust. The private sector market, so the guy says this is worth $5 billion. Pretty much there's 4 guys coming together and saying, okay, we'll call it $5 billion. And companies worth $1 billion don't disappear overnight. But companies worth $1 billion as rated by themselves. I'll give you an example. I run a company with a couple of friends of mine, or we own a company. I can call a third friend of mine, ask him to put some small amount to get 0.5%. The amount he puts for owning that 0.5% is the value of my remaining 99.5%. If I really know him well, I sell him 0.25% for 6 lakhs. But then give him my car and then say, yaar tu ye rakh le. So I want to value my company at that number. Nobody knows that I've given him a car. Find the 6 lakhs for 0.05% or whatever is what is extrapolated to 100% of the company. So we can value a non-listed illiquid asset as anything. You see people doing it frequently. They'll say, मेरे पास एक घर है वो 4-5 crore जाएगा. कहाँ जाएगा? कौन खरीदेगा? Nobody knows can answer that question. A liquid asset, a transaction that happens, that can buy the whole thing, that is the value of it. A notional number is just me saying, okay, my company is worth this many crores, or these many tens of crores, or these many hundreds of crores. So don't get caught in by valuation numbers just thrown in. Don't get caught in the glamour of being an intermediary and being don't hear these stories in terms of some of the fun magazine that you read. Understand what their business model is. Go through what they talk about, whether there is a compelling proposition there. I think if you're an intermediary like OYO, some of these guys are if I were a hotel operator, I would not become a completely on OYO only person. I'll say, Bob, I'll have your brand, I'll sell 25% of my rooms through you, but I want to be listed on my own. I want to be there on other places as well, in TripAdvisor, Make My Trip, etc. And I want to have my own loyal clientele, and I'll build a brand everywhere. If those terms are not comfortable for OYO, I'll say, yeah, good, thanks for all the fish, good luck. I'm not going to be married to one provider, because I know they can screw me over. If OYO is going to fail miserably, I don't think OYO will fail miserably. I think that at worst they'll lose some money. SoftBank will come in, revalue them at a different place. They've got a brand, they've got a giant footprint, and the hotel business Corona or COVID notwithstanding, maybe in a year and a half time, India is getting richer. China is getting richer. When you get richer, discretionary spend goes up faster. And travel is high on agenda for everybody. It's called as a growth experience or exposure avenue. So people will travel more. They travel more rooms get filled, more rooms get sold. If you have the largest footprint, you will survive. They're asset light. They've not built these hotels. They've just leased them. If something doesn't work, they'll say, look, this relationship is not working. This hotel, they'll just remove from their portfolio. So at the core of it, there is still something that's survival. Are they worth the many zeros they've added? Or do the hotels have brands to keep them in their place? That's a question for us to have. They'll survive and they'll be in some shape. They'll probably bleed money for so long and be valued at a point which is below the amount of money SoftBank has put in them for 6 years or 7 years or 8 years, whatever. That happens very frequently. So a $10 billion asset would have got an asset valued at $10 billion would have got a total funding of $2 billion at different points of time at different levels of valuation. They would have blown this money for many years. And then this guy who's funded this $2 billion will put in another $500 million when trouble comes. And then over the next 3 years, this will morph itself into a nice company that's worth $2 billion. $2 billion is a lot of money. It's a large company. It's a wonderful asset. But I've spent totally $2.5 billion or $3 billion over 6-7 years to now own a company that's worth $2 billion. It'll be part of my portfolio and then I'll run it systemically wonderfully and maintain some profits and all that. But that fantasy valuation disappears. It's a good deal for a bunch of people who participate in all the chatter and some trades in between. But in the end, it's not value accretive. What do you see is a path to billion plus valuation in the red tech industry, given Byju's attracts a lot of criticism from parents to school kids mathematics? $1 billion is a large number. I think because of this term unicorn, we've tried to get into as unicorn or bust. Fine. So I don't think $1 billion is a magical number that is required for a company to be meaningful. For me, unit economics comes supreme. Pedagogical measures are going to be the driver. Is your teaching actually impactful? Are you striking a chord? Can a kid who comes from class 4 with you learn everything with you till class 12 and learning wise get things? Are you not simply gaming the system, getting them? The big difference between Byju's and all of these other players. Right? So Byju's is not an intermediary. Byju's is a provider. Byju's has obscenely high gross margin. They don't have a gross margin problem. Fine. So they don't even have an operating margin problem. The cost of sales is 10,000 rupees per student. You take the revenue they make, subtract cost of product provision and cost of sale, they'll still make money. Fine. So according to me, Byju's does not face any of the problems these guys face. So it's a separate model. They're not an intermediary. Right? The issue perhaps with Byju's is that the industry is designed, or in my view at least, it's looking at gigantic pricing pressure from fabulous providers who can become local brands. Byju's does not have a fabulous moat around itself. The cost of entering into the space Byju's is not as high as the cost of entering into the space Ola is or Uber is. You cannot enter in a city like Chennai without having access to 3,000 cars. I can offer a completely integrated 6 standard course. If you give me 10 months, I'll do it for all subjects. I need a team of 3 people. Good, high quality, fantastic, into passionate people. You give them to me, 10 months, I'll offer 6 to 10. I'll put them in a room, they'll create fantastic content. There is no defense for that. So according to me, the big parallel for EdTech is going to be the telecom industry. So the telecom pricing in 98 was $16 a minute incoming and $12 a minute or something. Sorry, $16 outgoing and $8 or $12 incoming. Now it is closing in on 1,000th of that, at least 100th of that. And so that could be a team. The freely available content on YouTube today from some wonderful channel. That's a channel called Exam Fear, which is fabulous. You guys should check that out. There's this lady who's basically taken all subjects for all classes in multiple languages and really, really well. And it's freely available on YouTube. and I see the Byju's content and I see this lady's content, if I'm asking a 6th channel to choose one, 10 times out of 10 I'll say go up to this lady's content. She's teaching well. You don't need any other fancy gimmicks. Forget the money. You'll learn better in this than with that. So the low priced, highly valuable teacher brand content is going to shape our education scenario. I'm more interested in that rather than the ed tech sector. I'm not given to the language of unicorns and decacons. I would have spoken that language 10 years ago. I just get tired of it now. The value proposition online is phenomenal. I think the transition will be outstanding. If you have a kid or a nephew or a niece, then they're 10 years old and they're not learning online, they're losing out. In our world, you need to be learning online. So the value proposition of learning online is compelling. The acceleration into online will be good. EdTech has had 3-4 waves, but nobody has ever made money. Byju's does not have a gross margin problem, but I think Byju's problem will be the fact that there's no barrier to entry to this industry, and pricing pressure is going to be immense. Byju's might end up expanding and defining this market, and then facing threat from Tom, Dick, and Harry, who all teach well and offer at 1/100th of Byju's price point. And people might realize that not just a price point, their value offering is nice. We offer a product for school math for 6th, 7th, 8th at a fraction of the cost that Byju does. We give it to students for throwaway prices because we think it's very important that they learn well. And I don't like saying our products are better than our competitors' products. But sorry, our products are better than our competitors' products. In this case, it's a very simple product. It's not rocket science. It need not be priced at the ridiculous levels that Byju's is currently pricing them at. So I think they'll have a pricing issue more than anything else. Wonderful. Enough about Byju's. Airbnb, Uber, Ola, Zomato, Swiggy all act as aggregators, correct? And so cheap money has improved the value of intangibles. .com crash, where are you? Correct. So the GMV, the gross marketed value, transaction value, is very similar to the eyeball number that the .com crash number had. So all of us, Flipkart used to be valued on how much value they transacted. So Flipkart would say we have $1 billion a day. They're not selling, generating $1 billion of revenues for themselves on that day. They're transacting $1 billion of sales by providing incentives both sides, which is still an important landmark, which is brilliant. But if your gross margin negative and you do $1 billion, it is a dicey scenario. You need to have a path to gross margin positive. I don't know whether so I don't know the transacted volumes, the initial benchmarks, initial milestones. I need to be of a certain size to talk about profitability. So a lot of these companies have hit that size, and a lot of them have struggled. We've all assumed that once you become the incumbent, it becomes so easy to become profitable. All our fallen heroes are telling that you can be the incumbent and then struggle for profitability after that. I mean, once again, it's not Byju's issue. Byju's gross margin richly positive, and operating margin positive. Their threat would be pricing, not this. Wonderful, guys. I'm going to sign off. Lovely talking to you guys. We would probably do one of these every month or so to just shoot the breeze about business. This is not reading comprehension preparation. This is not maybe personal interview preparation, but to learn the language of looking at a business and analyzing it and talking about it and knowing about EBITDA and EBIT and gross margin and operating margin and GMV and transacted value, and getting an intuitive feel for how much value a company is adding, and are they meaningful, are they sustainable, do they provide something meaningful for everybody on the chain. And what about Unacademy? That is one company I'm not talking about, and we have a series of issues with them. So anything I say will probably be viewed on the basis of the several issues we have with them. So I'm going to stay out of that. Wonderful, guys. So I'm going to sign off. Happy Independence Day again. Enjoy your day. Enjoy your weekend. we'll catch back, say, in a month's time to discuss more of these.